Last week, one of my clients told me that they would love to downsize their home, but the homes in their neighborhood are selling for $1.5 million. And they're concerned about the amount of tax they will have to pay when they sell their home. So I explained how the rules work when it comes to the gain on the sale of your home and was able to show them that the tax is not going to be nearly as much as they thought it was going to be. Now, you may have clicked on this video because you're thinking of downsizing or selling your home, and you're concerned about how much tax you're going to pay when you do that. It's probably not going to be nearly as much as you think. In today's video, I want to explain, number one, how the rule works. Number two, give you some examples if you sold your home for $500,000 or $1 million or $1.5 million, just to show how the exclusion works at different levels. And then last but not least, I want to talk about things that you need to start pulling together so that you've got everything you need to minimize the amount of the gain that you actually pay tax on. Now let's start by talking about how the rule works. The rule says that if you have lived in your home for the last 2 out of 5 years, that you get to exclude $250,000 of gain per person. If you're filing as a single filer, you get to exclude $250,000 of gain. If you're married filing jointly, you get to exclude $500,000 of gain, because that's $250,000 for each person. That amount of exclusion is applied to the gain. So the amount that you bought the house for is your cost basis. That is not taxable. The gain is the difference between what you sell it for and what you paid for it, and you get to exclude up to $500,000 of that gain. So that can be a pretty hefty exclusion for a lot of people. Now, sometimes people will ask me if they can just buy another home within a certain period of time and have the gain in the current home be transferred to the new home. A very long time ago, that was the way it worked. If you've got rental property or investment property or business property, you can still use that 1031 exchange on that property to defer the gain, because maybe you're still carrying out that business interest, and so you get to defer that gain from one property to a new one. But when it comes to your personal residence, you cannot defer the gain. When you sell your home, you're going to pay tax on the gain, but you get to exclude $250,000 per person. Now, the way that looks, let's say that somebody bought a home for $200,000, and that was many years ago, and they're selling that home today. If they sell it for $500,000, then they have a $300,000 gain. Now, if you're married filing jointly, you get a $500,000 exclusion. So that $500,000 exclusion is more than that gain. So it covers the full gain. So there would be nothing to report that is taxable on your income tax return. You would not have any tax due on the sale of your home in that situation. What if instead they bought that same home for $200,000 and now they're going to sell it for $1 million? Well, as a married couple filing jointly, they can exclude $500,000. So $1 million minus the $200,000 that was paid for it is an $800,000 gain. They can exclude $500,000 of that $800,000 gain, and they will have to report $300,000 of the gain as taxable income. Now, the positive thing is that this gets reported as a long-term capital gain, and long-term capital gain rates are a preferential rate than ordinary income tax rates. So if they're, say, in the 24% bracket, they would be paying a 15% capital gains rate on that gain. Let's say that the same couple bought that home for $200,000, and now they're going to be able to sell it for $1.5 million. Well, that's $1.3 million gain. They can exclude $500,000 of that gain, and so they'll have to pay tax on the $800,000. And the tax numbers work the same. They're going to pay tax as a long-term capital gains tax, pay the net investment income tax. That's going to be a preferential rate to their ordinary income tax rate. We've talked about how the rule works and how much gain you can exclude based upon your filing status. But the gain that we've been talking about is the total gain, the difference between your sales price and your purchase price. And that total gain can also be reduced by the amount of capital improvements that you've made. Maybe you added on a room, or you added on a patio, or you did some things inside the house, upgraded the kitchen to be a much bigger and more expensive kitchen. Whatever things you've done to really improve the home itself, you can count those as part of your cost basis. Now, some things are considered more maintenance, so you want to check with your tax advisor to make sure what things would count as cost basis and what things are considered maintenance. But gather all of your documents or records or whatever you have about those capital improvements and make sure you have that ready before you get ready to sell your home. That way you know exactly how much cost basis you have, you know how much capital gain you can exclude, and then you'll know at different sales prices how much capital gain you would have to report and what that tax might be. As you're gathering those records, you want to also get all the records related to buying the home, your deed and your mortgage and your release of mortgage and all of those things. And then when you do sell your home, make sure that you keep all of the sales costs that go into selling the home, because those reduce the amount that you have to report as taxable gain. I hope you found that helpful, and if you did, hit subscribe, because I don't want you to miss any videos that could help you be on your best path in your retirement.